Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Nick Baltas and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Nick, it's great to be back with you as always. It's been a little while. How have you been?
Yes, correct. It's been a little while. I'm very, very glad to be back. I think last time was this first week of August. Very well timed just before my break. No, I've been... obviously I enjoyed the summer. We got back to Greece with family, and then beginning of September, when schools start again, here we are. So kind of planning now for the year end, a bit of travel, some good projects at work, and managing a 4-month-old alongside with my 6-year-old daughter is in itself, I guess, the new way of living in September.
Absolutely. Yeah, my travel season started as well. Unfortunately, also started with me picking up some kind of bug on the way back on my latest trip. So if I'm coughing a little bit along the way, we'll try to mute that as much as possible, but be warned. We obviously have quite a few topics lined up thanks to you. And as always, they're great. But as we also do every time we speak, I'm really interested in just sort of... what you're picking up on your radar at the moment, not related to the topics necessarily we're speaking about, but just sort of what you find interesting. I've got some completely random stuff that I wanted to throw at you, but what are you sort of finding interesting at the moment?
I mean, from a business standpoint, the one thing that typically keeps us on our toes, and now we also see another transition, is this kind of risk aversion that grows or falls as time goes by. And I think for the last year and a half, maybe, it has been a period whereby the vast majority of clients and investors would look into carry opportunities, maybe with some sort of short-lived breaks. I would call March last year as a good example. But suffice it to say that post-August, we are seeing more and more and more of this defensive mindset coming back. There is much less appetite, at least in the past 1 month, for carry trades. So in this regard, it is something that keeps us busy. And for almost like 2 years, it wasn't really the key point. So that is something that has drawn my attention, I would say, quite substantially. So in the last couple of weeks, maybe.
Yeah. I mean, it's quite relevant for our conversation, I guess. People interested in something that's a little bit more defensive for sure. I found some random stuff. I just wanted to mention that caught my attention. The first one is kind of related to the fact that in the month of September, despite, you could say, certainly growing uncertainty, conflict, whatever, equity markets seems to be fairly immune at this point. And I did notice that the latest valuation for OpenAI, because obviously that's the other big theme at the moment, kind of doubled from the spring to now 157 billion for a company that doesn't make much of a profit as far as I'm aware. And I did notice that that's more or less the same capitalization as the firm that you work for, and Uber and AT&T is in that range as well. So I thought that's kind of interesting. The other thing that keeps us busy generally is this idea of whether inflation has been conquered or not. Clearly, central banks have declared victory recently by starting to lower rates, including in the US. But there's a couple of things that actually did show up this week as something that could spark a little bit of inflation, in my opinion. One is that I think last night, so overnight, the dock workers that have been on strike for a few days, now they've agreed a 62% wage increase over 6 years. That's pretty decent. It might inspire other people to go on strike and try and get a better deal. Now, clearly, this is good news for a lot of people, especially those who love bananas, because apparently 75% of all bananas into the US comes through the East Coast ports. So that's obviously the good news. Now, another strike that is somewhat in the news is, of course, the strike at Boeing. I think last time I heard they had rejected a 30% pay rise over 4 years. So clearly these pay rises are meaningful. And I just want to I just put it out there as part of the conversation about inflation, part of the conversation about the dynamics and the changes we're seeing in the labor markets, where historically, at least for many decades, employers were at the wheel determining terms. And now it seems that is changing. Another thing that could be inflationary is the fact that this morning, just a couple of hours ago, we're recording on Friday, the European Union voted to impose tariffs as high as 45% on EVs from China. That's certainly also going to not hopefully, but it's going to put some price pressure, I guess, on these vehicles. And of course, we've seen some pretty decent move up in energy prices this week, given what's going on in the Middle East. So for me, those are kind of interesting things. They all point in same direction. But maybe for other people, the biggest news, Nick, that I picked up yesterday is the fact that apparently next week, we're all going to find out who Satoshi Nakamoto is, because HBO claim that that's going to come out in a new movie that's being released next week. So to all our Bitcoin lovers out there, that's going to be interesting.
So looking forward to it?
I'm going to watch it if I can. I don't know if I subscribe to HBO. I have no idea. But anyways, it'll be interesting to see what they come up with. I did forget one thing, by the way, that also is somewhat in the news is, of course, this Chinese bazooka that has been unleashed, which have certainly had an impact on the markets, especially Chinese equity markets in the last period of time.
I mean, yeah, and I think this also propagated in some commodity markets as well. We see things like iron ore, following a year of falling prices, having a significant rebound in the last month. I would say commodities as a whole had a very strong September, but coming from very, very different reasons. Whether that would be wildfires and drought for some of the ags. Obviously, we have the nat gas moves and the energy moves in the broader complex here. China impact in some of those metals. So, as a topic, I would say September was quite interesting for the commodity complex, both on the beta side as well as the implications for some of the systematic strategies we're running. It was not a great month, by the way, in this regard for systematic strategies on that front.
Sure. Good stuff. Well, I mean, we just opened the month of October. We just opened the fourth quarter. It's going to be a quarter where I guess the focus might be the U.S. election in a few weeks. But we should still talk a little bit about what's going on at the moment. My trend barometer at the moment, it finished at 36 yesterday, so not a great reading, a little bit weak. And I think that's being reflected so far in performance in October, even though it's only a few days old. But as of Wednesday night, Beta 50 is down 78 basis points in October, still up 3.34% for the year. SocGen CTA index down 92 basis points, up 1.56% for the year. SocGen trend down about 1%. Still, well, I have it down as 1.17% for the year, but I think it might be up 1.17% for the year. I think it's a typo on my side. And the SG short-term traders index down 63 basis points and down 10 basis points year to date. Contrasting that with equities, MSCI World down 1.25% roughly for the month of October, up 16%-ish so far this year. The S&P Global Developed Sovereign Bond Index down 8 basis points, up 2.34% for the year, and the S&P 500 down about 1% for the month of October, but still up a healthy 19.5% so far this year. I mean, you mentioned just before we jump into the topics, you mentioned a little bit about kind of performance, what you're seeing. Obviously, August and September has been interesting. We can pack it with some of the things that you wanted to start out with, which are reflections on August, but it may also include September. So why don't we just start with that? I know you've been traveling, having some interesting conversations, and it's kind of nice to have a real-time dialogue about what is being talked about.
Yes. So as we were preparing the agenda for today, I thought that reflections following the August moves for the for the trend world is an interesting topic. Not because we're going to go through and see what happened in August and so on and so forth. More so because I'm getting interesting discussions with regards to the impact of speed or the impact of equity defensiveness, or maybe lessons learned, if there are any lessons that we learned out of it. And having gone through that, do we have to change anything in the models? And we've run some analysis, and there are some interesting results that I kind of wanted to more like share with you, or maybe we kind of cross-check our views. I would say that August was very special in the sense that going through the downturn, and obviously with a big question mark whether that downturn would continue, we end up eventually realizing one of the fastest V shapes in equity markets. Eventually August was a positive month for equities, even if during the month, for example, Nikkei had one of the largest negative returns in history, right? And by the way, one other topic that has been discussed, but maybe not as much in the context of trend following, we saw the carry trade unwind, and some of the currencies that year to date have been delivering positive contribution, be it Japanese yen or China or Indonesia currencies, obviously turning the other way around and starting appreciating quite substantially in the middle of the month. So let me start from a couple of points. I should start firstly by saying that the underperformance that came from the reversion in equity markets primarily, and then some of the currencies, is something that, at least in my experiences, did not surprise anyone, in the sense that it does exactly what it says on the tin. You have been piling on historical trends. Year to date, equities have been rallying. There's a great performance that came up until end of July, let's call it. And then the reversion was literally the mirroring effect of being exposed to equities. Maybe what was a bit more, interesting year to date was that no other asset class was actually trading as much as equities, and therefore some dynamic risk scaling and maybe some conviction in favor of equities overweighted the asset class, and therefore after the fact you had a bigger, in relative terms, turning point. So I think that was one interesting conversation that we had with clients. Is it actually worth allocating more to trendy asset classes or not?
Can I?
Yeah, please go on. That's the first point, right? That's the first point.
Exactly. So on that point, what I would say is, I agree with you that from a trending behavior, you could say equities has been a great sector. But here's where some of the other moving parts in a trend following model comes in, because what we did see starting in, say, Q2 was, of course, the reversal of the short fixed income trade. And for those who use correlations as part of their risk management, that would actually lead to the equity exposure being reversed or reduced over the summer, because suddenly you have two positively correlated asset classes being long. So that is one thing that I just want to throw in there.
And that's absolutely fair. I'm actually looking at some stats. You're absolutely right. Around maybe May coming into June, we saw some relative reduction in the risk in equities, primarily coming from the rates move, which I have to say, however, getting closer to August and the reversion of those rates moves, you ended up reducing the rates exposure, and then just before the reversion in equities, you ended up kind of allocating a bit more to equities. I guess the important point goes as follows. The reversion, had you been quick, would have been at your benefit if the downturn was contagious. So I think there are two important points: assessing the downturn in itself, but then assessing the month as a whole, and assessing the V-shape. So before I go there, let me give you the second interesting data point, at least as far as I'm concerned. Currencies, including the August reversion, have had so far, I believe, in 2024, the worst year of attribution in a trend program in their history, or maybe the last 25 years. I don't think this is something that has been well discussed, at least in our calculations. Just to say it again, so I don't confuse anyone, the FX attribution in a trend program year to date has been the most negative it has historically been across the asset classes for any other calendar year. I don't think this is very well communicated or maybe well understood, but I think it's something worth pointing out. Now, to get to more interesting results, at least for me, the V-shape gave rise to the question, should you be quicker or should you be slower? So we've run an analysis whereby we look into very short-term signals to more longer-term signal. Let's call it 1 or 2 months of, let's say, some rolling window or a half-life. It doesn't really matter. Up to, let's say, 12 months. What happened in August was that being faster or slower would get you better off than being somewhere in the middle. So let me explain that. Having an average speed which is relatively, I guess, medium term, 3 to 6 months, will get you worse off than being faster than that or slower than that. And obviously the question becomes like, how is that possible? And this is possible because the V-shape has two effects. Either you're too quick to go short, then it reverts and you're quick to go long, so you participate partly on the downfall as well as on the recovery, or you're too slow and then you don't really react to it because by the time it's down, maybe your gross exposure dropped by a bit, but then it recovers, you're still long. But there is a middle point, like a sweet spot or maybe a bitter spot, that as the market drops close to the trough, you start reverting the exposure to short and then it rebounds and you don't even recover. Like I tend to use this example whereby you have, the physics 101 we did back in school days. There's a frequency at which the soldiers are synchronized on the bridge and the bridge falls, right? And I think this is a good example whereby we have this V-shaped dynamic and this was enough for a medium-term speed to be the worst of all the others. And frankly, when we started running the numbers, I was not expecting this result to come out. I thought that being faster would actually get you better off. But the reality is, conditional upon the recovery came, being much slower or much faster will get you in a better place. Now, do we change the model? My answer would be absolutely not. Like, I'm sure we can find other examples whereby one would be better, the other one would be worse. So, beyond just data mining, I don't see any other value from just seeing that this V-shape that, happens to be a typical false positive, which, however, was very aggressive. I'm not sure what has been your experience in your conversations, but I think to me that was a very, very interesting example of like neither extreme will get you as badly as a middle point, which is typically what we would follow as a normal speed.
Yeah, no, I think these are definitely talking points at the moment. And there is someone out there interested in the trend space. He doesn't know that he's inspired me to look into these things. It's just something that I picked up from conversations where, they have convinced themselves that a certain speed is the speed. And of course, I beg to differ on that point. In fact, the speed that you're mentioning as being the worst in this situation, it's kind of the speed that they think is the absolute best. So it just shows you that you can't really conclude that. Now, I can give you an example where longer term speeds were not great, and it was actually COVID. And what I mean by that was that downturn was just enough, like 3 or 4 weeks, where we as longer term trend followers had positioned ourselves short equities and I can't remember, long bonds and whatever, just because that was enough time for our models to react to that. And I completely agree with your finding that in August, it was just so quick that our models, yes, they reduced risk mainly because of vol expansion, not so much about the signal making a change for those few days. But of course, what determined also August to some extent is how you had handled the yen, the Nikkei, over the summer months, because there were signs of a change in direction, or at least there were signs of those trends being challenged. Let's put it that way. They were not as strong as they were early in the year. So I agree completely with all of that. Now, it actually inspired me to get our research team to run some analysis using different fixed look back periods. So all the way from 20 days as the shortest one, to 260 days as the longest one. And
pretty similar
then also
pretty similar to mine then.
Okay, and then on top of that, we ran how we do it actually in the model where we don't have a fixed, we have a cloud of different look back periods, and the selection is actually dynamic. And I mean, to no surprise, and this is very important that what I say now, when I talk about short term trend following. And in this case, we're just using 20 days. It not only is it by far the worst look back period, but it doesn't mean that I mean that short-term trading can't be profitable. It's just short-term trend following I don't think is profitable in the long run. This is a 20-year simulation that we did, and obviously this is subject to all the disclaimers that you need to state when we talk about simulated returns, of course. But there were some short-term managers that probably would have done better than the results I look at. The next then you see a big improvement if you kind of triple that. So 60 days definitely over this using this raw trend signal improves a lot. It's actually quite similar to 130 days. Between 60 days and 130 days, not a lot happens after 20 years. Obviously, during that period, there will be a difference for sure. But once then you get longer. Say you double that again to say 260 days. There's a big improvement by a big factor, actually, in terms of the quote-unquote simulated returns that it produces. And then, as we probably will see in some of the papers as well, once you start being more active, dynamic in the selection of parameters, which is how we do it on our side, you can actually make even further improvements, is our finding. So I completely agree with you on these findings. And of course, it's a choice what kind of trend following you want to do.
I would say, almost like paraphrasing or adding to your points, that I think the choice of the speed, there's no sweet spot for me. The slower you are, the less reactivity, I guess, or lack of ability of capturing a turning point error you have. So that's the typical type 1 error, let's call it, or like type 2 in this particular case. The quicker you are, then you have more false positives. Now, striking a balance between the two, net of costs gross of costs is a choice that is a pure trade-off. Accounting for costs, the faster you are, the bigger the impact can be. So there comes a point whereby becoming even faster will get the costs eating up much more of your ability to react. And therefore, you don't even have to go in that unless you have a very strong cost control system. Now, that's the first point. The second point I would put is that you're mentioning COVID and how being reactive is obviously kind of helpful in terms of turning the corner. I would even add to that by saying that looking into August on a month that the market was positive doesn't even appear if you do your typical kind of scatter plot with a trend following smile and the convex and so on and so forth, right? There comes a point beyond which you did not have trend following respond to a downturn because the downturn was so short-lived. So, it didn't deliver the convexity. It would have done so if that was fast and the move was contagious. Now, it's another discussion to be had as to whether the V-shape, is something we can learn from it. But it's not ultimately a downturn that you would have expected a short or medium or longer term trend following to deliver return. The last thing I would say, maybe counter to your and my views, static position sizing would have helped because you wouldn't have reduced your equity exposure throughout that V shape. So it would look more like as a beta move more than anything. I'm not vouching for it by any measure, but I'm just saying that there are some counters, and we can always find examples that one single choice justifies, I guess, a dogma. But I would not suggest that this is a lesson that I learned from it. I'm just putting it out there for the benefit of the conversation.
No, I agree with you on the equity exposure, but we also have to take into account that a static position sizing and all the other
yes.
in the yen and all of those things would have had a negative impact.
I'm data mining.
Yeah, you're data mining a little bit, but that's fine. Now, the other thing that I was curious about as we did this analysis was, okay, but what about the quote-unquote protection capabilities that people want from these strategies, how is that impacted by a look back period as well? And just to make a long story short, what I also found was that the longer you go, you actually get more performance during those periods where there's equity crisis. Now, of course, I have to add to this that this is based on crises that are quote unquote meaningful and long. I don't mean about a week or 2 week crisis, so to speak. And I think what the period has highlighted, and hopefully for investors, is that and there are obviously different ways to deal with these things. Also, if you're long only or if you're an equity investor, but it's just the price we have to pay for delivering the long-term compound growth. It is the fact that we will go through these periods. Some of them will be too quick for us to hurt, and some of them will be just long enough for us to be caught. And that's just how it is. That's just the way of the world. You can't. I mean, if you start trying to overthink your models and try and remove negative periods because I don't really like that, you end up in a bad spot in the long run. Is my experience, at least.
I mean, I completely agree, and I think I've been clear. We've discussed it several times. If we really after like a daily move or a 2-week or 2-day move or a weekly move, we are not following trends anyway by design. This is precisely the space that maybe requires some contractual protection, which, by the way, it's even more expensive. I'm not saying it's not the right approach, but there are ways that we can combine option-based strategies, buying some optionality with trend following. I completely agree with you. It is in those long-term sustained drawdowns that you get the outperformance. It's not in a short-lived downturn that eventually ends up reshaping. And I think testament to, hopefully, the amount of content and industry reports and education that people like you are actually offering to asset owners. Post August, we've seen none of our business activities, or if you like, discussions leading to any particular challenge or potential thoughts of unwinding a trend following exposure. It's absolutely clear. It says exactly what it says on the tin. If the trend is continuing, it does the job. These are the scenarios that you would have to be exposed to, quote unquote, for the long-term benefits, right? Being defensive as well as long-term sharp.
Well, this is the thing, and I would actually go further that, okay, we had an event in August, which was really a non-event, but the events from the last couple of years, in particular things like 2022, I think it has opened up the discussions. I certainly feel that there are more people who are now serious and who want to dive deeper into these type of strategies, and are willing to put action behind their research, which is obviously great in my opinion. Now, I am interested in if you have other things you want to talk about from your sort of recent travels. I know there were a few other points, or you want to jump into the next bigger topic we wanted to talk about?
Look, I think segue to the next topic. Maybe it's this a very basic empirical finding that goes alongside what you said. I just remembered it because you said 2022, and I think it's a nice step to the next topic we're going to discuss. What are the 3 worst calendar years of S&P since 2000? Can you guess? I'm not putting you on the spot, but I'm pretty sure you're going to find them.
No, I mean, I would say 2001 maybe, or 2. I can't remember.
It was 2.com, correct?
It was 2. Okay, yeah. So and then 08 and then 20. Yeah, and then 2022.
Correct. So .com, yeah. GFC, and the inflation crisis.
Yeah.
What have been the best 2 duration years?
Duration years? What do you mean?
As in fixed income, buying bonds.
Buying bonds. What have been the best 2? Oh, I can't remember. But it wasn't. 2022 was not one of them.
So exactly right. So .com and GFC, best years for bonds.
Okay, right.
2022, the worst year for bonds. What are the 3 best years for CTAs?
2022 would have been one of them. Yeah. 2014 would have been another, I would have thought, and 2008.
Exactly. And depending on variation, actually 2002 is one of the 3, and 2014 is actually the 4th. So you're absolutely right.
All right.
It's like those 3 plus 1. So the point I think we're going to get to, which is more about equity, bonds, and so on and so forth, at least to me, it's an interesting path towards equities do the job, fixed income has done the job, but what do we do now going forward with all those dynamics in 2022, trend following, and all that lot? I think that's now the time to move in that direction.
Now, Mann wrote a paper. Edward Hoyle at Mann wrote a paper. I thought it was a very good reminder, actually, for me when I read the headline. The headline is the name of the paper is, risky business: why the smart money forecast risk, not returns. And it goes very nicely with what I certainly often have said to people I talk to, probably on the podcast as well, and that is, CTAs, much to people's surprise, we are first and foremost risk managers. And we have no idea what returns we're going to get from the markets, but we have some idea of what risks we take. And this is exactly what they're getting at. So do you want to dive into this a little bit, or...
So I guess the gist of this work relates to whether we can forecast returns, whether we can forecast risk, and what does that mean? And I'm talking about the short term. And what does that mean for asset allocation, as in combinations of equity and bonds, and even maybe commodities down the line. So they start by effectively looking into a realization of returns and volatilities for the stock market for the last 100 years, and by no surprise, they do find that there are those times whereby risk is elevated, as in volatility, but then subsequent to volatility spikes, volatility remains high, whereas there is no association between today's realization of volatility and tomorrow's returns. And this seems to go against academic principles that basically suggest, if you experience risky moments, you should anticipate positive returns going forward. It's not necessarily against it. I think what is missing here is the context of the horizon. And I think they just put it nicely here. They say, look, yes, when risk is elevated and I'm in a down market scenario, it is more likely than not that in the next, a year or 2 or 5, my equity return will be positive above and beyond cash, to, if you like, to satisfy the premise for expected returns rising in a down market. But that doesn't happen next month. So today's risk has no forecasting ability for tomorrow's return, but it's actually a good predictor of tomorrow's vol. So today's risk is related to tomorrow's risk, but today's risk is not related to tomorrow's return. And, taking that as a given, then they end up saying, look, if you have like a 60-40 portfolio, well, maybe you should think more about how risk is distributed. Because in a 60-40 portfolio, it ends up being 90% equity risk and 10% bond risk. And in down markets, not only is that becoming more risky because volatility is rising, you're not even compensated for it. So the portfolio as a mix of equities and bonds, becomes more risky, whether it's the volatility that is going up or the two can actually start correlating or breaking their correlation. I think 2022 was a prime example that both of them correlated highly, both of them falling. And the point they bring forward, which I think has been well discussed in the industry for years, is that first of all, you need to account for risk, and that is like vol. So at the minimum, scale your exposure as a function of realized volatility, because you don't have a good predictor of returns. I mean, you said it yourself right now, when we do trend following, in a way, that's what we do. We scale down when the market is falling. And if you take it to the other level, you end up shorting the market. But even by just reducing the exposure in a vol spike, you somehow implicitly play a trend. And
this is, of course, one of the big debates we've had over the many years on the podcast, because obviously with technology as it was back in the 70s and the 80s, that's not how trend followers started out. They had the static position sizing and some still do, of course. What is somewhat interesting actually on that point is that I think it's fair to say that probably most of the bigger managers today, they would certainly embrace dynamic position sizing. I think that I feel certain when I say that. But I also know, of course, of people who don't do it. And it's not that I could say specifically that their returns are vastly different. I don't know about their sharp. Maybe that it will show up in the sharp a bit. But it is sometimes difficult to tell the difference once you zoom out a little bit between the two. Now, on a month-by-month basis, okay, maybe you could detect who's doing what. But long term, and maybe that goes to the robustness of the underlying strategy itself, and the signal generation itself. In the long run, maybe the difference is not vast. And sometimes, and this opens up so many doors.
I can go
I say
in,
that. So maybe I should stop
I can
now.
go in many directions now. No, go on. I'll tell you my view.
No, but it's a little bit the same idea. This argument about should you trade 500 markets or 50 markets. I mean, it's it'll be different from time to time. Will one be vastly better than the other over time? I don't know. I'm on the sideline on that. I don't think it will be, and I certainly don't buy into the point that trading 500 markets is better than 50 markets. But now I've opened two contentious topics in one sentence, so I need to really be careful now.
No, look, I'll say the following: if volatility clusters, which they show that it does, and we have so much evidence that today's volatility is a good predictor for tomorrow volatility, and there is no association between volatility and expected returns in the short term, and we have experience for some of the markets, there's a negative association between volatility spikes and subsequent returns, in contrast to what financial economics would suggest, then you're better off scaling the exposure as a function of vol, because you scale down prior to negative realizations and you scale up prior to positive realizations. The reason why I feel over the longer term you can get to similar profiles or performance statistics with more static versus dynamic positioning, to your point, is because volatility, beyond the fact that it's clustering, it's also mean reverting. So over the longer term, you have some exposure that you go in and out on a dynamic basis, but over the longer term tends to average out to some sort of long-term vol. However, and I think that's the most important point that, as far as I'm concerned, is not the long-term performance, but the local one, specifically around the turning points, specifically around the times that it matters the most. Like, actually, you reminded me now, I'm going off tangent for a second. 7-8 years back, we wrote a nice paper with a good friend, and this was about predicting equity market returns. And there's this vast literature that says, you can use, dividend to price or earnings to price or GDP growth, or there's a variety of predictors for equity returns. And there were some models in the literature that were suggesting that, hey, you need to constrain your model, because if you constrain your model to only predict positive numbers, otherwise you should scrap your prediction if it's negative, then you outperform in the longer term. And our point was the following: equity returns over the longer term are positive by design, purely because they constitute compensation for you taking on growth risk. Now, if you constrain a model, however good or bad that is, to only keep the positive returns, over the longer term, you would favor beta, because they happen to be more positive than not. It's almost as if I'm telling you to predict a coin toss, and you tell me, look, it's 50-50. But if it's 70-30, the probabilities, by design, if I constrain my model to only give me positive numbers, I'll be close to the 70 rather than the 30. So it might look that those models look better over the longer term, but my point is, what is the case in a down market scenario that you think you have a positive expected return, you're piling on equities, and then you're getting hit by your prediction? Are you actually remaining solvent? So that was the point we were making, that maybe over the longer term, assessing prediction models and suggesting that a particular model is better than another might have, statistically better performance, because it captures the 70% of the times that this was positive, but not the 30 that it was negative. But at the time it was negative, living that through and managing money on behalf of that model, you might not even live up to the longer term to suggest that your model was a good one. And I think that's what happens here as well. And there are those choices that matter in the micro scale, possibly not in the macro scale, but it's the micro scale that our money ultimately is managed. And that's, I think, why it's very important. Anyway, I can digress all the way.
No, that's fine. Now, we talked about volatility and forecasting that and using this in your models. I think they also bring up correlation forecasting as well. What are your thoughts on that, actually?
So when we build, there's a nuance here, right? So when we build a portfolio of two markets, correlation doesn't really matter. It only matters for leverage. So if I have $100, whether I do 60-40 or inverse vol one, inverse vol the other, and I sum them up and I divide by the sum, so I still have $100, then correlation doesn't really matter. Like, if they become more or less correlated, it would simply be that I would need to, it would have no impact whatsoever on the relative holdings between the two. They would just come from the inverse vol dynamic in a risk parity world. Correlation only matters for the top level leverage if we have a vol target. But if you have a vol target, we don't have $100. We need to lever up or lever down. So the point they're making on that is that if you have a vol target, then it's absolutely critical to keep in mind the fact that when equities and bonds suffer like they did in 2022, not only does the risk go up because the volatilities increase, but also because the correlation goes more positive and you overshoot the, I guess the vol you thought you had, right? So the point they're making is that simply by scaling your exposures as a function of vol, it's also important to take into account correlations for better distribution of risk in a way. I'm a proponent of this approach as long as correlation is not too noisy and ends up creating more costs than not. But the point of the paper is to start from a 60-40 equity allocation, a 60-40 portfolio in notional terms would have much more risk coming from equities, would have a realized volatility that is very time varying. And this is precisely the consequence of individual vols as well as correlation. Then they say, how about you have a vol target, which in itself allows you to scale the exposures inversely to vol, but also have a top level leverage adjustment to hit that vol so that it reduces your vol of vol, the portfolio is better behaved and more balanced. And then they say, how about you also become active or more frequent in assessing those volatility ratios, because that eventually performs even better, precisely because it's now active and taking into account the contemporaneous dynamics around vol. So these are the three kind of transitions they go through: nominal allocation, long-term risk allocation, as they call it, static, and then active risk allocation as a function of the realizations of vols and correlations. That's basically the whole story. It's not too different to building risk parity portfolios in a way. The way at least I read the papers, it's about risk parity portfolios and being risk prudent, which is something that you and I think I agree very much so.
That's a kind of a nice segue because there's a third paper, or maybe it's the second paper. I can't remember what paper we're on now, by Longtail Alpha that talks about risk parity and trend following together. So maybe you can talk a little bit about their findings.
Yeah. So I guess the starting point is on this one is the end point of the previous one that says, okay, suppose that I have a risk parity portfolio between equities and bonds. Okay, fine. So better risk balance between the two. If I account for leverage, as in correlation between the two, I also have a vol target that is kind of well behaved through time, but I still hold two long exposures into asset classes that there are times that both of them fail, specifically when the equity bond correlation goes positive. So beyond the fact that the volatility can overshoot if that correlation spikes to positive beyond my projections, I'm also exposed to the fact that both of them can sell off. So by design, if I hold A and B and A goes down and B goes down, at whatever vol or correlation, I'm just going to lose money. So the point is, what can we do in that portfolio? And it's no surprise that the historical negative correlation between equities and bonds allowed those portfolios, whether it's 60-40 or risk parity, to perform very well. But then the 2022 case comes around and they make the point that, hey, trend following can help you. And they go into this journey of like adding trend following, like a basic trend following example. Like you can even think about the stocks and trend index. They use, I believe, another index. I can go into the details. There's a Credit Suisse index that we're using. Anyway, it doesn't really matter. It's a trend following strategy that you can add on top of equities and bonds. And lo and behold, it kind of works. It is helping. And then they go one step further that say, okay, how about we replace bonds with trend following? And that, to me, brings me back to maybe a couple of years that we're discussing about bond replacement with trend following, as opposed to portfolio completion with trend following. What they find, no surprises, is that adding trend following over the longer term in the place of bonds leads to a relatively worse portfolio, or maybe, let's say, similar portfolio to having stocks and bonds. But we know the story, right? Historically, over the last 20, 30 years, following fixed income trends and taking negative exposure, if, for example, there was like a short-term underperformance in fixed income, you wouldn't be paid for it, because the reality is just a long bonds exposure was good enough. Of course, the story changed in 2022, and I think that's where the transition in the paper goes and says, look, why do you want to go short positively carrying assets, as in bonds? So then they introduce that flavor and say, maybe we should do a trend follower that doesn't go short assets with positive carry and doesn't go long assets with negative carry. Did I say that correctly? Let me just rephrase. Do not go long appreciating markets that have negative carry. Do not go short depreciating markets that have positive carry. That comes from bonds, right? No, do not short bonds if you're experiencing an upward term structure, because you have to pay the carry, and therefore do not trust your trend. And of course, what that brings, no surprise, is that in that, they call it carry optimized trend program, you are not shorting fixed income historically as much as you would with an unconstrained trend, and therefore you don't pay the premium of the negative carry prior to 2022 while still benefiting in 2022, right? So that's the enhancement above and beyond just adding or substituting bonds alongside stocks, still in a risk parity context, right? Concluding, they end up also adding commodities into the mix. So if you add commodities alongside stocks and bonds, historically, yes, you have some diversification benefits, but Sharpe ratio drops. This is no surprise, because maybe for a decade or two, the negative roll yield in those commodities would come at a cost. But incorporating the carry flavor in the trend following camp allows you also to avoid those commodity positions. So putting everything together, they finish off by saying, if I build disparity portfolios between stocks and bonds, whether I have commodities there or not, and they do bring some benefit and some value, having a carry optimized trend following strategy is adding much more than just beat asset classes. But again, it kind of reminds me, maybe the first time we spoke, period, was at the time that we had 2022, and I was making the point that maybe one of the more successful inflation hedges is to go short bonds, you go short equities, and you go long commodities. And you find yourself paying the equity risk premium, you find yourself paying the term premium, and you find yourself being exposed to the negative roll yield. And trend following at the minimum can allow you to be a bit more dynamic around those dynamics. And it's no surprise that in this paper they say, hey, if I have stocks and bonds and maybe commodities at the time that I have stagflation and so on and so forth, I'm benefiting from that. So that's the whole story, right? I mean, a nice paper, easy to go through. Is it something groundbreaking? Yeah. I think we know the stuff, right?
No, exactly. And again, I very quickly glanced through the paper this morning, and
I agree with the carry screen, by the way, in a way.
Yeah. No, well, yes and no.
There's a purity part.
This is the thing, right? This is the thing. Now we have to get it out of the system, right? We talked about it a little bit earlier today. That sure, you can go back and I don't even remember how long they went back.
I'll tell you, it's go back 98. Let's call it like 25 years.
98.
25
years.
Of
course, 98 is kind of exactly when this carry regime started, right? So clearly you could have found a benefit of excluding or finding ways to limit the short positions or short exposure to fixed income. But here's my point, is just that this is exactly what I mentioned earlier on. trying to be too clever and adding stuff to a trend following model to avoid some of these periods that you don't like. I just think it's a dangerous game because we don't know what the future holds. And clearly, the first 20 years of this century is probably going to be very different when we look back in 20 years. You and I doing this podcast in year 2044, hopefully. And we're going to look back and say, oh, Nick, do you remember when in 2024 we talked about this study and they had found a way to reduce the negative drag from going short bonds? But boy, in the next 20 years, you wouldn't want to do that because look at where rates are at 25%, whatever. So all I'm just saying is I like the purity of trend following, not being too clever, not trying to forecast, not trying to overfit. And yes, you pay a price for it, but it makes it more robust in an uncertain, unknowable future, in my view, humble view.
I remember the days, maybe 10 years ago, a bit more, 13 maybe, when the first few years post-GFC, post-2009, 2010, some of the underperformance started coming through. There were a number of doubts as to whether trend following would work if rates go up.
Right.
I'm sure you remember those days.
We had Roy Niederhofer was on the show because he wrote a paper in 2014 making that point that longer-term trend followers would not be able to make money when interest rates started to go up. And we brought him back a couple of years ago, Alan and I, we talked about this particular paper because I remember it caused a lot of challenges for us in the longer-term camp because people believe that narrative. And what Roy said on the podcast, it's somewhere in the episode, he said, well, he didn't expect the yields could invert.
Yeah, I remember.
That's the funny part.
I do remember that.
We don't know what the future holds. And in this case, shorting bonds was one of the most profitable trades for a long time after having been long bonds being one of the most profitable trades, maybe as long as you and I have been around.
We just discussed it, right? Yeah. Taking those shorts back in time, was not compensated for.
Anyways, let's bring it all home. We've still got another 10 minutes or so. Let's bring it home with a paper that is very familiar to yourself because you're one of the co-authors of it.
I thought of discussing that part primarily because, by the way, it's on sizing. Primarily because I'm getting more and more questions these days because I think there's a lot of industry maturity post-2022 as to what is the value out of trend following. And obviously the question then becomes, how much should I allocate to it? Okay. So the sizing question, once somebody starts looking into it, becomes, I guess, of existential nature because it's very hard to come up with a number. And we wrote something 5 years ago. It was November 2019, and that's precisely how much should somebody allocate to trend following. And interestingly, there was another paper from one of the large CTAs that came out a couple of months ago on the same topic, and even the approach that they take is very similar to what we had 5 years ago. In that conventional ways of determining sizing do not work. So let me go into the specifics, right? So being agnostic about what is your asset allocation and what is the alternative you want to add to it, modern portfolio theory would suggest that you put those two numbers in an optimizer. You have some expected returns for asset A, expected returns for asset B, some volatility, some correlations. You build some efficient frontier, and then you have a portfolio that is maximizing the Sharpe ratio. That's the tangent portfolio, for example. Now, if we take any SAA, equities, bonds, call it 60-40, call it risk parity, we've discussed it at length in this past hour. Just have your SAA, and then you put next to it.
And for people who don't know what SAA means.
Strategic asset allocation. Yeah. So strategic asset allocation or policy portfolios for the asset owner community is a guideline as to how their core allocations should play out. And then typically, depending on the organization, you have an overlay, you might have any liquids bucket. There's obviously and that I guess is the alternative complex that goes alongside the strategic asset allocation. Of course, there are tactical components. That's the TAA that we typically talk about, or DAA, like dynamic asset allocation. In case you need more acronyms, I can continue. But anyway, long story short, if I have an asset allocation, which is a blend between fixed income, between equity, with some regional tilts depending on the mandate. What more can I get from a trend follower, assuming that we know that we can get this convexity, this protection in extreme downturns and so on and so forth? How much do you allocate to it? That's the question. So what is the expected return of trend following to put into a mean variance optimizer? Like bluntly, if you ask me, I'm going to tell you 0 because I have no clue and it shouldn't work in the first place. I think Andrew made a very nice point recently, said people that don't feel comfortable about trend following is because it goes against their premises and their fundamental understanding of the market that, past returns should not predict future return, right? But the fact that it does, cannot be ignored. Let's say we use historical Sharpe ratio of trend following. Doesn't really matter. Just pick a number. That number historically, as a Sharpe ratio, is more likely than not even higher than an equity bond portfolio. Let's call it equity bonds is like 0.6. We can say a CTA or a trend follower could be like 0.7, 0.8, 0.9. The numbers don't really matter. What matters at the end is that any mean variance analysis would tell you to do 70% trend following, 30% the remaining of your portfolio. So we're overlaying an alternative allocation with the strategic allocation. It doesn't really make any sense. So conventional ways do not work. Then you can say, you know what? Scrap the expected returns and simply focus on a minimum volatility portfolio. How can I minimize my volatility? Well, I can solve for this combination that the downside risk, for example, is minimized by the addition of X units of trend following. And I'm talking about on a funded basis. We can solve it for unfunded allocations. It doesn't really change the result. Even that, and I can quote some of our analysis, gives you a 52%. And I'm using here data from 1999 until 2019. As we said, this was work that we did 5 years ago. So that now basically says you do 50% trend following, and another 50% equities and bonds. It's too high, right? It's too high as a number to be consumed by an institution, right? So then what we suggested back then is that there are two driving forces here. And these are the ones that should be balanced in determining that size. And that's where this basically paper goes. Basically says, if you're holding a policy portfolio, a mix of equities and bonds, this is your benchmark. And benchmark has a very important psychological impact in how investors operate. I mean, not just investors, all of us have a benchmark to beat in our personal lives, in our professional lives. If you beat the benchmark, you're better. If you miss the benchmark, you're actually underperforming. So anything you do away from it is an active risk decision that unless it's properly rewarded for it, you'd rather not have it in the first place. But any active decision consciously comes with risk. That's the typical active risk that we talk about in single stocks, for instance, right? So how big should that size be of allocating some dollars into another alternative? That's the question, right, that we're having here. So the point that we're making here goes as follows. There is no way you can maximize your returns. There is no way you can minimize your downside risk because both approaches would give you unrealistic numbers. What you really have to assess is a scenario analysis and value add of various increments of trend following allocation, be it 2%, 5%, 10%, 15%, but then calculate a tracking error, quote unquote, as to how much you now deviate from your benchmark, because that's now your risk. The more you deviate from it, the better your tail characteristic would look, the better your Sharpe ratio would look, the better your downside performance will be, the more likely it is that you're going to you remain solvent in a way, in a down market. But that comes with a business or a career risk. So where this kind of story concludes is that it's a balance between those two. What are those characteristics you're after in terms of longevity of an investment? And I think the industry paper talks about a 1-year horizon versus a 10-year horizon changes dramatically your perception about CTAs. Maybe in a year, the value add is not as great as it is in a 10-year. So the horizon is very important. The downside risk mitigation is very important. Maybe the long-term Sharpe ratio is the consequence of those two. But any decision becomes an active decision. Where do you draw the line? It's very different to me and you. That's the typical risk aversion in a different concept, right? And I'm not saying that allocating into a trend follower is a risky decision. All I'm saying is that it has to be seen as a strategic decision, but sizing it should not be too small because the impact would be tiny. But the more it becomes, the more conscious an institution should become about a tracking error to what ultimately everyone is assessed against. And I think it's very hard to go against what we are assessed by. Maybe, and I think we've discussed it here a couple of times, maybe the strategic asset allocation should change and contain maybe 5 or 10% or 20% of trend following. And that now becomes a different story, because if that is the benchmark, then we have more room to play with it, right? And I think this is where the industry is at the moment, whether a 60-40 or a risk parity combination of asset classes is the right benchmark and the policy portfolio to be held, or managed futures becomes part of that ecosystem and is accounted for as a core component in SAA, as in strategic asset allocation, for the lack of a better acronym. So that's the whole story about sizing. I think it's a very, very, very important topic for asset owners.
No, I think it's crucial because it is what's going to move the needle at some point. If we do see a change in the way these quote-unquote benchmarks are constructed. Maybe my final question, because you wrote this paper 5 years ago, as you said, maybe it's too early, but do you see any signs that the strategic asset allocation, quote unquote, the benchmark, is slightly changing to maybe allow for a high allocation to things like trend following?
So you mean introducing trend following in the strategic asset allocation?
Well,
or allowing for bigger size?
Or maybe in a sense saying, well, maybe the 60-40 isn't the best today. Maybe it was for 20 years, right? But maybe today, 4 years after interest rates found a low, in a new environment, in a deglobalizing world, whatever the arguments may be, in an inflationary environment we haven't seen for a while, maybe 60-40 as the starting point is really not where we should be having this conversation from. I mean, because that is, as you say, that will allow more room for, quote unquote, the positive tracking error, hopefully, that things like trend following could introduce.
I would answer by saying that I don't see the reverse. Like I do not see any specific, gravitational power holding now asset owners into the 60-40 premise. Like there are challenges that are coming to the surface. Month after month, year after year. These are not the same conversations I was having like 5 years ago. The fact that this report became again relevant for a good amount of our clients is precisely the consequence of those questions now being asked much more than in the past.
Yeah, I completely agree. I see the same.
And that's why I said, look, A, we need to bring it again and discuss it, and B, having one of the large CTAs producing pretty much the same report in some variation of the analysis 2 months ago, I think it's testament that it is a topic that is heavily discussed. It's not that, hey, let's talk about that, because I think it's interesting. I think it is a topic that most of my current discussions are going about.
If I can throw in a little bit of a topic that we can think about maybe for next time we talk, even though it's probably not something we have much knowledge about. But I feel this conversation is changing simply from the fact that, bonds had a big sell-off. People realized that there is risk in owning bonds. They had maybe not seen that for 20 years or so. But that's purely performance-driven. When I read some of the news, the reports about the debt levels we're running, continuing to run, and the accumulated debt that we have out there from government side, I mean, that in itself should also, in my opinion, be part of the conversation as to why maybe 40% in bonds is way too risky today compared to what it was 20 years ago. But that's not where our focus is today, because so far no government, or big government, has defaulted on their debt. But when you read some of the, I was reading, not that I spend much time on Substack, but I did see whatever was on the free level from Richard Werner in terms of the debt levels in the US that he posted this week. And it's absolutely terrifying when you read those numbers. Anyways, it's a discussion. It's a big discussion for another day, but it should be part of why the 60-40 is maybe not the right measure to start with.
No, I agree with you. Like 60-40 was a carry trade and a yield reduction in a turning point. Now, which of those components can still be there? I think that's a big question, right? And I couldn't agree more with you.
Yeah. Well, let's end on a point of agreement. That's always a good place to end. Nick, this was tremendous, as always. So useful, so insightful. And I'm sure everyone listening today will have picked up a lot of new and important stuff from you. And I hope for people who listen in that you're going to show some appreciation to the work Nick has put into this by going to your favorite podcast platform. Leave a rating and review. Tell Nick how great he is. That's always a good way to bring him back in a few weeks. Another great person will join me next week. That's going to be Rich. So if you have questions for him, probably more hardcore trend following questions, I could imagine, do send them to me. info@toptradersunplugged.com is where they should go, and I will bring them up. From Nick and me, thanks ever so much for listening. We look forward to being back with you next week. And until that time, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.